Today I'll be explaining why businesses record expenses before actually paying for them. This may seem a bit confusing at first, but it's an important practice in accounting. We call this process accruing expenses, and it's all about getting an accurate picture of a company's financial situation. To start, let's talk about accrual accounting. This is a method businesses use to track their finances. It's focused on when things happen, not just when money is exchanged. Let's say someone did a job for you. They complete the work this month, but you don't pay them until next month. In accrual accounting, you still want to record the expenses this month because that's when the work was done. This is where accruals come in. Even though you haven't paid yet, you still want to accrue the expenses. This means you recognize the cost of the job in your financial statements right away, so your records show that you've used a service or product even if you haven't had the money leave your bank account yet. Another example is I currently work for a corporation. Right now we are in our accrual week, so we go through all of our invoices and we like to document anything that hasn't been paid. What we do is we write down that invoice and how much of the cost it hasn't been paid, and we like to put it on a spreadsheet, put it in the system, and let the system know, hey, this invoice hasn't been paid. Let's hope it gets paid by next month. This might all seem confusing, but I'll go in a little more depth about it and explain why it is important. Accrual accounting ensures that your financial records are accurate and match the actual timing of when things occur. For example, if you're reporting expenses and profits for a specific month, you want to capture everything that happened during that month, even if you haven't paid the bill yet. When you accrue expenses, you match them to the right period when the service was provided or the goods were delivered, not when the money changes hands. This helps businesses understand their true costs and profits for a particular time period. For managers and investors, accruing expenses provides a clearer picture of a company's financial health. They can see not just the cash that's been paid out, but also what's been incurred, helping them make informed decisions. Think of it like buying groceries. You get your groceries today, but you don't pay the bill until next week. You wouldn't want to wait until next week to record that expense, right? Accrual accounting ensures that you account for the groceries as soon as you've used them, even though you haven't paid for them yet. So in short, businesses accrue expenses before paying for them to ensure that their financial records are accurate, to match expenses to the right time period, and to provide better transparency for decision making. This helps